So in this section, I'll go into technical analysis for stock trading. So one thing to point out is that technical analysis, there is a lot of stuff, a lot of information out there. You have, things like pivot points, RSI, MACD, moving average, support resistance, trend line, trend channel, and candlestick patterns, and much, much more. And my goal right now over here is not to teach you everything about technical analysis. I can't do that. Instead, what I'll do is to focus, alright, to get you focused on the key areas of technical analysis that matters. That's all I'm going to do, right? To give you a strong foundation into technical analysis, and then from then on, if you want to explore further, you have the tools, the knowledge, right, to go about doing it. Okay, so when you're dealing with technical analysis, right, let's say in stock trading, right, you know that fundamentals, they are good, right? It helps you to filter down the list of stocks that you want to trade, right? Focusing on companies with strong or good fundamentals. Technical analysis, on the other hand, can help you to time your entries, telling you when to buy. Right? So fundamentals tells you what to buy. Technical analysis can tell you when to buy. So when you are dealing with a technical analysis, there are three broad categories that I want you to know. It's what I call the trend, the area of value, and entry trigger. So let's analyze them, right, in depth. So a trend, right, you've probably heard of a trend, right? So what is a trend? A trend is simply, right, on your chart, it looks like higher highs and higher lows, like this. Okay, let me just draw this, right? Higher highs and higher lows. So this is what we call an uptrend, because you can see that the price, right, is making higher highs and higher lows. And one thing to note is that when we are dealing with technical analysis, when a stock is in an uptrend, we want to be a buyer, because we assume, right, that there's a good chance that the stock would continue to trend higher. So this is an example of an uptrend. So the opposite of an uptrend, right, it's a downtrend, which looks like this. It has lower highs and lower lows. So when a stock is in a downtrend, right, we want to be selling. We don't want to be buying, because, again, right, there's a good chance that the stock will continue trending lower. So one of the important principle that you want to take away is that whenever you want to buy stocks, right, you want to buy stocks that are at least in an uptrend, or at least, right, don't buy stocks in a downtrend, especially for trading, right? This is not investing where you're going to hold on for years and years. In trading, right, you are going to enter the markets and you'll pretty much exit, right, after a short while, depending on your time frame, but you won't be holding stocks for a long time. So again, first fundamental rule of stock trading is, again, don't buy stocks in a downtrend. And one tip to share with you is that to define a trend, right, you can use the 200 period moving average, right, to help you, define the trend. So let me share with you an example. So the 200 period moving average is just an indicator. You can get it on most charting platform, right? Just select 200, right? And over here, this black line is what we call the 200 period moving average. So I've applied this to the daily time frame on Amazon, and you can see that right now, the price of Amazon, right? This is the price. Over here, there's movements. This is the price of Amazon. It's above the 200 MA. So when you see the price is above the 200 MA, right, it gives you a bias that, hey, I want to be buying only in this market because the market is in an uptrend, okay? And vice versa, right? If the price over here, the price is below the 200 MA, then you can conclude that, the market is weak, right? And you either want to be selling, right, or, hold on to cash. You don't want to be buying in a downtrend. Of course, there are exceptions, right? Especially traders who are, more advanced in their trading methodologies, they are more experienced, they can buy in a downtrend, they can still make money. But for you, if you're still new to trading, this rule over here, right, will keep you on the right side of the markets more often than not. Okay, this is not foolproof, but hey, it will keep you on the right side of the markets more often than not. Okay, so this is what I talk about, what we have discussed, right, the trend. Next thing, area of value. So that trend, right, tells you whether the stock is moving up higher or lower. But just because a stock is moving up higher doesn't mean you buy it immediately. Okay, just because you see oranges in a supermarket that's selling right now, you don't buy the oranges immediately, because maybe the oranges is overpriced. Maybe the oranges is selling like one orange for $10. You don't buy one orange for $10, right? Because during a sale, you can buy maybe 3 oranges for $2. So you want to wait when the price is at an area of value for your oranges. And this is the same for trading, right? You don't want to buy just because the stock price is high, it's in an uptrend. No, you want it to come to an area of value before you consider buying. Okay, and it's the same for trading. So how do you sort of, define what is value in trading? So these are a few techniques that you can use: support and resistance, trend line, moving average, right? I find that these three, they are pretty easy to understand and use. There are more out there, again, but I would say these three, right, really, right, is more than enough to get you started. So let me explain, what are these different tools that you can use. So support, right, you can think of support as a floor, right, where the price have difficulty, going under, like a floor. So you can see that over here, okay, I want you to think of this floor as a wooden floor. Means it can provide some support, right, to push the price higher, but it's made of wood. So wood can also break. So don't think that, just because the price is coming to an area of support, right, it will definitely bounce. No, wood can break. It's not titanium, it's not metal, right? It can break. So that is how I want you to think of support. So in this case, right, you can see that over here, we have an area of support over here. Price bounced once, rallied higher, came back down under, bounced a second time, and rallied higher. So you can see that support is an area, it's not a fine line on your chart. So this depicts it pretty clearly. You can see that over here, this whole area is an area of support. It's not just one line, even though I draw it as a line because that's my preference, but you have to treat it as an area, meaning that the price could come into an area of support and then bounce off away. It could come deeper into that area of support and then reverse from there. That is possible as well. So remember, support is an area on your chart. Treat it like a piece of, a wooden plank, okay? The second thing that I want to share is a trend line. So trend line is like support, right? Like support and resistance. But the difference is that support is horizontal. A trend line is, diagonal, okay? So trend line is diagonal. So you can see that again, it's an area. This is the area over here. And notice the price bounce here, the second bounce here, and the third bounce over here. Okay, so this is, again, a trend line. When you want to buy stock, again, you want to buy when the price is near an area of support. You want to buy it, right, when the price is near the upward trend line, right? Because this represents an area of value on your charts. And the last thing to share is moving average. Okay, so you know that there are many types of moving average out there. Like, for example, earlier I shared with you the 200 period moving average, how it can help you define the long-term trend. However, that's not the only moving average you can use. You can use the 20, 50, or 100, and all these different moving average, right? They help you, they have different purpose. Like, for example, I like to use the 50 MA, okay, which is what you see over here, to help me define an area of value. So you can see that for this particular chart of Nike, the daily time frame, the price tends to, bounce off the 50 MA, repeatedly for over the last few times. So needless to say, right, if the trend is very strong, it may not retrace back towards the 50 MA. Sometimes it might just bounce off the 10 or 20 MA and continue trading higher. If the trend is a healthy trend like what you are seeing right now, right, where the pullbacks are more obvious, it tends to find support at the 50 MA. And if the trend is, let's say, not very strong, pretty, it's just weak, right, it can even pull back to the 100 or 200 MA. Okay, so again, moving average is another technique that you can use to be to define your area of value. So one thing to note is that, let's say, for example, the stock right now, it's let's say it's trading at this highs over here. Okay, let me just give another example. How about the stock is at this highs over here? Let's say the stock, previously it has respected the 50 MA and now it just breaks out higher and got this slight price rejection. At this point, you don't necessarily want to be buying over here. Why is that? Because remember, you want to buy in an uptrend and from an area of value. Right now, the price is not at this area of value, which is at this 50 MA over here. So it's much better, right, to be patient and let the price come to you, come to an area of value, and then you look to enter your trade. So now the question is, when exactly do you enter the trade, right? Let's say the market is in an uptrend, it's an area of value. Do you just buy it immediately? No, right? Because you can actually use something what I call an entry trigger to time your entry. So entry trigger, right? I find that candlestick patterns, they are very useful for this purpose. Okay, and you can use, reversal candlestick patterns like the hammer, the engulfing pattern, bullish engulfing, bearish engulfing, and shooting star and stuff like that. So if you don't understand, right, I'm just going to, run you through quickly, right, about candlestick patterns, right, and these are different reversal candlestick patterns, which I find that is useful to know for your trading. So how do you read a candlestick pattern? So candlestick pattern, right, it's a recap, right, it's useful for an entry trigger to help you time your entry. And to read a candlestick pattern is that you would usually see, two types of candles. It's green or red. So if the candle is green, right, this over here, right, is the opening price. Okay, and this over here is the closing price. So this means the market, the price opened at this level, went all the way up higher. This is the high for the day. For example, let's say you're looking at the daily time frame. This is the high of the day, and then finally closing near the highs over here. You can see this lower shadow. This is called the wick, lower wick. Right? This tells you the low of the day or the low of the candle. Okay, so there's only 4 things to know: the high, the open, the high of the candle, and the low of the candle. So when you look at a bearish candle, it's the opposite, right? The open right now is on top, okay? And the close is below. That's why it's bearish, right? Because the price, right, has actually closed lower for the day. So now this candle is in red color. Again, this is the high of the day, and this is the low of the day. So this is how you read candlestick pattern. And moving on, right? There are many differences. Many different type of candlestick patterns out there, but I find that a few that are worth knowing, right, is for example the hammer and shooting star. So let me just explain to you, right? So again, this is a green candle. Okay, you can see that the price opens over here, right? The open for green candle, right, bullish candle, the open is always below the close. So this is where the price opened, and when it opened, right, notice that there is this long lower wick over here. So what it tells you is that during the day, the sellers actually came in and pushed the price down all the way down lower to this point. Somehow, they couldn't push the price lower anymore, and the buyers came in, took control. Okay, they're on steroids, right? And they pushed the price up all the way up higher, and finally closing near the highs over here. So what does this tell you? This tells you that, hey, buyers are stepping in, right? They have managed to, take control from the sellers and push the price up, closing above the open. So this is a sign of strength, right? Telling you that the buyers are in control, and that's why you get a candlestick pattern like this, which what we call a hammer. Tung tung, hammer. So on the other hand, right, a shooting star is just the opposite of a hammer. You can see that again. This candle is it's bearish, it's red. So the open is here, right? When the market opened, buyers took control, pushed the price up higher, up to the highs of this day over here. Suddenly, the sellers, said, hey, that's enough, I'm coming in. Then it's they smash the price lower, all the way down to the lows over here, and finally closing near the lows. So this is the open, this is the close, this is the low, and this is the high. So again, a shooting star, if you read this, right, this is a sign of weakness, because it tells you that the buyers, they are no longer in control. The sellers are in control, and that's why they can, push the price lower for the day. Okay, so this is hammer and shooting star. Another couple of candlestick patterns that you should know, right, is what we call the bullish engulfing and bearish engulfing. So it's very similar to hammer and shooting star, just that this time around it's in the form of 2 candlestick patterns, right? There are 2 candlestick patterns. Whereas earlier you just saw, right, it's just one individual candlestick pattern. But the message behind it is pretty much the same. If you look at this one over here, is what we call the bullish engulfing pattern, right? Sellers took control and close near the lows over here, right? It opens here and close near the lows. The next candle, buyers opened near the lows and took control and pushed the price all the way up higher, closing, right, even above, right, the prior candle high over here, right? This is a sign of strength, right? Showing that, sellers took control, they pushed down the price lower, and then suddenly buyers came in, pushed the price up higher, and finally closing near the highs. So this is a sign of strength, as it tells you that the buyers are in control. On the other hand, right, bearish engulfing pattern is just the opposite, right? Buyers on this first candle, they are in control. This is the opening price. They come up all the way up higher and close near the highs of the day. Remember, what is this? This is the high of the day, and this is the low of the day. Then the subsequent candle, this candle over here, the sellers, they open near the highs, and suddenly, I don't know where they find the strength, right? Maybe, took too much creatine, steroids, and protein shake. Bam, right? They smash the price lower and finally closing near the low of the day. So this tells you that now the sellers are in control, and this is what we call a bearish engulfing pattern. Okay, so you can call the hammer, shooting star, bullish engulfing, bearish engulfing as reversal candlestick patterns, because they sort of help you time market reversals or market turning points. Okay, but you don't just want to blindly trade them. Just because you see a bearish engulfing doesn't mean you short. Doesn't mean you see a bullish engulfing, you buy immediately. No, you don't do that, right? You want to use a few technical tools together, right, to increase the odds, right, of your trade working out, which is what we're going to discuss right now. So I want to introduce to you what I call the T.A.E Framework. Okay, so this is a framework that I came up with. So again, we're just going to combine what you've learned so far. Number one is the trend. So you recall earlier, if the price is above the 200 period moving average, chances are, right, it's in an uptrend and you want to have a long bias, meaning you want to be buying the stock only. You don't want to short sell the stock, okay, if the market is above the 200 MA. Similarly, if the price is below the 200 period moving average, you want to have a short bias. And if you cannot short, right, at least you don't want to be buying when the price is below the 200 period moving average. Okay, so this gives you a bias to know whether you should be buying or whether you should stay on the sidelines, meaning, you know, you stay out of the markets. Okay, because short selling is something that I would say is more advanced. Not all of you can, you know, short sell the stock market. So again, just know where I'm coming from. Second thing, area of value. We mentioned earlier, just because the stock is in an uptrend doesn't mean you want to buy. Just because there are oranges selling in the supermarket doesn't mean you buy that orange, right? If it's one orange for $10, $100, are you going to buy? Well, I won't buy. I'm a cheapskate. I want to buy when it's, you know, 2 for $3. 1 for 5, I mean 5 for $1 maybe even. I mean 2 for $3. I mean 3 for $2, or maybe 5 for $1. I'll buy when it's cheap, when it's of value to me. Okay, because not really a huge fan of orange, right? So it has to be at a value price before I buy those oranges. And it's the same for trading. You don't want to buy just because the market is in an uptrend, just because the price is high. You want to buy when it's trading from an area of value. An area of value can be defined as, you know, support, resistance, moving average, trend line, right? Stuff that we've covered earlier. And then, right, the last thing that we want to look at is entry trigger. We want to look, right, at the price and tell us that, you know, hey, you know, the buyers are now in control and now is, you know, a safer time to enter the trade. That's how, you know, candlestick patterns can help you, right, where it shows you patterns like the hammer, the bullish engulfing pattern. It tells you that now the buyers have stepped in, right, and there's a good chance the market could reverse higher. So this is the T.A.E framework, combining these three, right, and you can actually have, you know, tradable, right, or trading opportunities, right, that you can trade off using technical analysis. So here's an example, okay? So you can see over here, the price above the 200 MA. So should you be buying or selling? Buying, I hope you said buying. Yeah, buying, right? You should be buying. Okay, so now, the price is above the 200 MA, you should be buying. Do you buy it over here? Do you buy it over here? Or do you buy it over here? I think Rayner said something about trading from an area of value. That's right, area of value. So where is an area of value on the chart? So from the looks of it, right, you can see that over here, previous resistance now turned support and now becomes support. And the price came into this area of support. That's great. We have the uptrend, we have an area of support. The third thing we're looking for to tell us that the buyers are now in control. I think this looks like a bullish engulfing pattern. Yeah, it looks like a bullish engulfing pattern. Hey, there you have it, right? Uptrend, area of value, and a bullish reversal candlestick pattern. So this, right, it's a trading opportunity that you can take advantage of. You can buy on the next candle's open. Your stop loss could go a distance below this low, right? And you know, hopefully, right, the market moves, right, in your favor from this entry point. So we're not going to discuss too much about, you know, where to take profits and stuff like that, because this is really just the beginner's introduction to stock trading. But I hope I gave you a good understanding, a foundation, right, to know when to buy a stock. Okay, so this is one example of the T.A.E framework. Another one over here, you can see that again, the price now above the 200 MA. Should you be buying or selling? Selling? No, buying, right? That's right, buying. So where is the area of value? In this case, we notice that, right, hey, this trend line seems to be an area of value, right? Market bounced off here second time, and on the third attempt, right, it bounced off and it formed a hammer. So look at this candlestick pattern. Notice the price over here, it opened at this the lows, okay, below the low of the prior day, came all the way down lower, and then the sellers, you know, said, hey, that's enough, right? That's enough. And they pushed the price all the way up higher, closing near this highs of the day. On top of it, you're trading or you're buying in an uptrend from this area of value on this trend line support. Okay, so you can see that in this case, right, the market that did went higher from here. So one thing to share is that all the charts that I'm sharing with you right now, they are cherry picked. I repeat, they are cherry picked. So I've purposely picked those charts, right, that shows you winning trades, because I find that it's easier to explain the concept. But when you're trading in the live markets, right, trust me, there will be losers. Yes, there will be losers, right? So I want you to prepare for it, all right? So all these examples, right, is just to let you understand the concept easily, right? Because it's much easier to explain. But when you're trading live, okay, or even when you're paper trading, right, there will be losses. No matter how fantastic your analysis is, no matter how good the fundamentals, how good the technicals, there will still be losses. Embrace it. But don't worry, in the later section we'll talk about risk management, all right, so that even if you have a loss, right, it's not the end of the world yet. All right, so that's later. For now, I still want to share with you more examples, right, of this T.A.E framework, because it's powerful. So let's have a look, okay, at the T.A.E framework. So this is the chart of Google, right? You can see over here Google, and let's see. Let me find it. Okay. So you can see that again, right? This time around, notice that if I just zoom out a little, the 200 MA now acts as an area of value. So prior to this, right, I said that the 50 MA, can act as an area of value. But in this case, right, the trend of this stock, right, it's not as strong, right? So it tends to find support, right, at this 200 MA here and here as well. Again, the concept is still the same, right? Stock is in an uptrend. It's at an area of value, and then what are we looking for? What are we looking for? Well, we can look for a candlestick pattern, right, as an entry trigger to enter the trade. So in this case, we have something what we call, in this case, right, it's again, this is something like a hammer. Price, right, hit down lower, buyers to control and close near the highs over here, right? You can enter on the next candle open over here, right, and go long, meaning you buy the stock. Another opportunity over here, right, price came down from this hammer, right, this hammer at this 200 MA and an area of value. In this case, it might be a losing trade. Again, this is a good example of a losing trade, as the price just continue lower, all right, might stop you out and then reverse from here. So this is really the reality of trading. No matter how good the setup is, right, there will be losses. Okay, so let's have a look at another example. How about this COST? Okay, weekly time frame. So this time around, I just pull out the 50 MA. Okay, so you notice over here, this is the chart of COST, Wholesale Corp. This is the weekly time frame, and again, right, it doesn't matter what time frame you're trading, whether the weekly, the daily, the 15 minutes, right, the concepts, right, can be applied the same. So in this case, right, Costco Wholesale Corp, can see that it's been respecting the 50 MA. Right, if I pull out the 200 MA, I can guarantee you that the price is above the 200 MA as well. Right, so just get out the 200 MA. Notice that the price is above the 200 MA. So you want to be a buyer. So now, where is an area of value to trade from? Okay, so area of value could be the 50-week moving average. Price has bounced once, twice, thrice, 4 times. And let's say, right, you miss this move over here, and over here you have this huge spike over here. Again, this is it's a bullish reversal, right? Price open near the open at the lows, okay, came down at this point at around $117 at one point before the buyers finally stepped in, pushed price and closed near the highs over here. So you can see that this is a huge, right, bullish reversal candlestick pattern. You may or may not trade it, right, but in this case, right, the market, the price went higher from here. But this is a very huge bullish reversal candlestick pattern. Again, the concepts is the same: trend, area of value, entry trigger. Let's have a look at one more, shall we? Something that is familiar with us. Facebook. Okay, Facebook. Okay, in this case, again, the price above the 200 MA. Let's say, it bounced off the 50 MA quite a number of times. Here, 1, twice, and over here, 3 times. Third time. So over here, you can see that how the candlestick pattern is useful to help you time your entries. That notice over here, right, there really isn't any valid entry trigger, right? This is not a hammer or a bullish engulfing. This over here is not necessarily a bullish engulfing. I think it's more of a piercing pattern. I would say this candle over here, right, is the closest to a bullish engulfing. By right, theoretically, right, a bullish engulfing the lows, right, should be below the prior candle lows somewhere here, and then it engulfs the previous candle and then close near the highs, right? I would say this is the closest because again, the range of the candle is large, showing you conviction from the buyers, right? In this case, I would say this would be the closest to a bullish engulfing, although it's not really, right, a textbook bullish engulfing. But if you can read price action, right, you know that over here, this one is a sign of strength. We have volatility contraction, meaning the market went quiet for a while, and on this candle, boom, right? Buyers came in to control and, you know, closed near the highs over here, right? So anyway, right, this is an example of not really a textbook example, but showing you that from an area of value, right, and then waiting for a candlestick, reversal candlestick pattern to go long. Sometimes you may not get the exact textbook setup or example, and that's where your price action reading of the markets would come into play, right? Another one I would say is more straightforward would be this one over here. So this one over here, a price, okay? So one thing to share again, right, the 50 MA, the area of value, it's never a line on your chart. It's always an area. So you can see that over here, it pretty much breached below the 50 MA and then on this candle form a hammer and then close back above the 50 MA, right? Giving you a bullish hammer to go long, to buy. Okay, so this is another point that I want to share with you, right? That your area of value on your chart, it's always an area. So I hope this gives you a few examples, right, of the T.A.E framework that I've just shared with you. So as a recap, right, here's what you've learned so far. We have, you know, covered quite a bit. Number one, we talk about trend, right? You want to be buying in an uptrend and selling in a downtrend. If you can't sell in a downtrend, you cannot short, at least, you know, don't buy in a downtrend. Stay in cash. Number two, we spoke about area of value, right? You don't want to buy just because the stock is in an uptrend. You want it to come to an area of value, okay? One thing to mention is that for me personally, I don't always trade from an area of value. Sometimes I do trade breakouts, but that's another topic altogether. But for you right now, for starters, right, I would say it's much, you know, it's better to be trading from an area of value, right? Buying it when things are cheap. And area of value can be in the form of support and resistance, moving average, trend line, right? We shared quite a number of examples earlier. The third thing is entry trigger, right? Using candlestick patterns, right, to help you time your entry, to show you that, you know, the buyers are now in control or the sellers are now in control, right? So candlestick patterns gives you clues, right, to let you know who is in control. And finally, right, we combine all these three different so-called principles, if you want to call it, right, these three different aspects of technical analysis and develop it into a T.A.E framework that you can use to find trading opportunities in the stock markets.